Hey, it's Dr. J. Welcome, students. Welcome to Chapter 8 of the course. Chapter 8 is going to cover accounting. Accounting is important for many different reasons. This chapter is going to go over the fundamentals of accounting, understanding what accounting is, different types of accounting measurements, and accounting processes with business. Okay? So, accounting, decision making by the numbers. So, accounting, who uses it? Everybody uses accounting. If you work for yourself, if you're an entrepreneur, if you work with a partner, if you work for a business, if you work for a partnership, if you work for a nonprofit, a for-profit, or a non-for-profit, everybody uses accounting. It's a method of keeping track of your expenses, liabilities, and assets. Okay? It also helps with understanding how much revenue you're going to make. So, many accounting measurements are liabilities, assets, debits, credits, revenues, things like that. So those are some basics. Now there are public accountants, there are management accountants, and there are government accountants. Those are three different types of accountants. You could also get your certified public accountant certification, which is a CPA. That's a separate certification, but a lot of people that are in accounting have CPAs. It provides them with notoriety. It gives them clout in their field, and it also, says to everybody that they're a subject matter expert, aka a SME. All right. Okay. So the financial accounting intended for those on the outside looking in. So accounting is all about the books, understanding the books, and what the books mean to the future of the business. Okay. Like we talked about in a couple chapters back, a organization or a business has the tendency to be successful when they project themselves 3 to 5 years out. Their accounting measurements are outlined, and they're going by that budget. So within 3 to 5 years, you're going to find out if that company or organization is going to be around for the long haul or not. Okay? All right. Ethics in accounting. So ethics in accounting is interesting because there's been terms thrown around such as cooking the books, which means that they're either floating the numbers, making them higher than what they really are for any one particular reason. We talked about the Enron scandal that was happening there, and when you cook the books, you're trying to make an appearance like there's more money there than there's not, because shareholders look at the books, board of directors look at the books. The books, if they're public, then the public has the right to look at some of the books. So it's really important because with accounting measurements, often based on your current books, that's how you're going to, measure out and find out if you're going to get additional funding or capital from businesses, board of trustees, shareholders, stockholders, based on what your books are looking like now with the money that you're currently already using. All right? Okay. All right, so revenue, expenses, and net income. Those are three terms in accounting that are used frequently. So revenue basically represents the increase in your cash flow within the organization that represents the cash or other assets such as accounts receivable. Okay. Expenses are, monies that are going out to things that you have to pay for. Okay. And there's a difference between, overhead and expenses. So overhead is when you have a perceived amount of money set aside for things like salary. Okay. When you're paying your employees, that's not technically a expense you're going to measure out monthly. It's going to be something that's projected out based on if they're a salary employee, an hourly employee, things like that. All right. Your net income is the profit of loss that the firm earns in the time of the period covered by the income statement. Okay. So if your income statement runs 30 days, then your net income is going to be based on that 30 days. Okay, that's why when they look at your, your salary or your income at the end of the year, they say, okay, what was your net income for the entire year? Okay, what was your gross income for the entire year? All right, that's the difference between that. All right. So we're going to go on to independent auditor reports. So remember when I was talking about FDIC? Well, FDIC they're basically financial auditors, okay, which is how the banks get their money to ensure that your money is insured. So remember, there's internal auditors, external auditors, and government auditors. So essential, you have, state, federal, and private auditors. So FDIC represents the federal auditors. State auditors are still, considered examiners when they're looking at, books and liabilities and revenues and income statements, but they are not federally, ordained to say, all right, then this money can be insured because, it's great. Basically, having a private auditor and a state auditor just completely solidifies when FDIC comes to the bank and says, okay, we're going to look at the books. And they can even, ask to look at other people's reports based on what the books were, looking like then. And they can take all that information in consideration based on when the books are getting reevaluated. All right. Okay, looking for trends and the comparative statements. So it's really important when you're doing, accounting items to look at a comparative item based on a specific amount of time. So if you want to compare revenue trends for this past year, then you're going to review the entire 12 months from, let's say January to December. That's going to be your 12-month mark. Versus like with the federal sector, they have a fiscal year. So their fiscal year always ends in September and then it picks back up. So that's when their budgetary items are replenished. If, after they review the items, they say, okay, yeah, we're going to go ahead and replenish these items and, give you additional budgeting for it. But the comparative trends are really important because they can give you a perception analysis of what kind of money you're going to bring in, what kind of debt you're going to incur, and how that's going to mesh with, your supply and demand aspect. Because remember, supply and demand and that equilibrium is right in the middle. All right. So in order to make sure that you're able to facilitate a proper supply and demand statistical analysis based on your books, then you also need to understand the comparative trends with your books based on what you've been doing thus far. Okay? All right. So we're going to go to financial budgets. So there's all different types of financial budgets. There are personal financial budgets, there's professional financial budgets, there's academic financial budgets. It just depends on what the industry needs to use. For example, your personal financial budget could include something as simple as, your assets and liabilities, your debts and your credits. So you could make a spreadsheet of all of your monthly living expenses, which is different than items that you just purchase. Okay, so you can have a spreadsheet just for living expenses because those things are not going to change. Things like electricity, gas, water, cable, if you have it, gas, groceries. Those are living expenses that are constantly reoccurring that pretty much are not going to change unless you change your, living environment, okay, versus just regular expenses. So some regular expenses would be things like if you wore glasses or contacts, okay, you could budget that in your financial plan and say, okay, this is something that reoccurs, twice a year or, every 8 months or something like that. So that way, when that item shows up, you're already budgeted for that specific amount of money, regardless if you actually realized, oh, I have this expense coming up, because when you're looking at your spreadsheet, on a monthly basis, you're able to go, oh, this expense is coming up. Or you could say, my glasses are still good. Or if you get your prescription renewed, oh, my prescription hasn't changed, so I don't need glasses. So now you can change your expense items and say, oh, well, the prescription was covered by my insurance, if that's your case. And then now you can add that amount of money to your budgetary items. And then now you're in a surplus of whatever you would have spent. Okay? All right. So there's the master budget, and then there's other budgets. So the master budget for a organization, your company, yourself, that has everything in it. It normally is broken down into, like I said, the assets, the liabilities, the debits, the credits, revenue, capital, okay? Or even if you have loans. So everything is on the master budget, from your monthly expenses to your weekly expenses to your daily expenses. Okay, you can even do daily expenses. So a lot of times the master budget is completely everything, and you could do branches off of that master budget under that same, Excel spreadsheet or whatever you're using as far as the line items go, and you can break it down so that way you don't always have to constantly be referring back to that master budget, which is a little overwhelming at times because you're seeing everything as a whole. Okay? All right. Okay, out-of-pocket costs. So out-of-pocket costs, if you use medical, dental, life insurance, any other type of insurances, then out-of-pocket cost is the amount you're going to pay that is not covered by another entity. So, for example, if you're a business and you have you produce books, okay, you print books, your out-of-pocket cost is going to be whatever you have to pay, excluding what the vendor is going to give you to print their books for them. So that may be ink, it may be labor for packing the books, it may be lunch breaks, things like that. So out-of-pocket cost can be that. On the insurance side, out-of-pocket cost is pretty simple. It's whatever your insurance does not cover. So if you go to the dentist, as an example, and you get a root canal, and your root canal costs $1,700, okay, and your insurance is going to cover $1,000 of it. Your out-of-pocket cost is going to be $700. Okay, that's what that is. So it's the difference of whatever's not being covered. All right, so that was chapter 8. I'm doing real good. I made this one under 15 minutes. So that's my goal, is to go over the main points of the chapter so that way you get a better idea of the content as a whole. But if you have any specific questions, you're more than welcome to either give me a call, send me an email, or even come by my office, because I am here for your success. All right, guys, have a wonderful day.